If your portfolio right now is 50% S&P 500 and 50% technology stocks, you really have about 80% technology. Guys, the truth that you must know about the S&P 500 before it's too late is simply this. The S&P 500 is not nearly what it used to be. Now, let me explain that. Most Americans believe that the S&P 500 is this safe, diversified, long-term investment. That's really a lie, because today, right now, the S&P 500 isn't really a 500 stock diversified portfolio anymore like it used to be. Today, the S&P 500 has slowly turned into really a glorified tech ETF, where just 10 companies control about 40% of the entire index, called the S&P 500, right? If those 10 companies happen to fall or fail, your entire portfolio is going to fall if you're heavily invested in the S&P 500. Now, let me break this down because I want to explain what I mean here. Let me make it simple. If the S&P 500 was hypothetically $1,000 total, let's just hypothetically say that the entire S&P 500 is $1,000. The top 10 companies alone in the S&P today would control about $401 of that $1,000. And one company in particular, Nvidia, would be about $73 of that $1,000. Now, that's not nearly as diversified as you would think. Now, let's go back 20 years ago. This may help illustrate what I'm saying. Right after the dot-com bubble back in 2005, tech was not dominating the S&P 500 the way it does today. Back then in 2005, tech stocks were only 15 to 17% of the S&P 500 20 years ago in 2005. Fast forward to today, tech and tech-like influence is pushing nearly 40% of the S&P 500. So think about it. We went from around 16% tech exposure 20 years ago to almost 40% tech exposure in the S&P 500 today, inside of what people think and have been told is a well-diversified index of funds, right? That's really a massive shift that is not talked about as much as it should be. Now, why do people still think that the S&P 500 is so diverse? Because Wall Street markets the S&P 500 as being diverse, right? 500 companies, 500 plus companies. That sounds really diversified, right? But what they don't tell you is the S&P 500 is a weight-based index fund. The bigger the companies get, the more they're going to dominate the index. So you don't own 500 companies evenly spread across the board, right? No. You own 500 companies weighted based on their size. So the bigger the company, the more giant the company, the more weight that company carries in the S&P 500. This means the bigger they are, the more they dominate. Thus, you have these huge tech giants in the S&P 500 competing to control most of the S&P 500. Now, that takes me to this, okay? This fact. The gap has exploded. The top of the index, those mega cap companies that we're talking about, they've pretty much pulled away from the rest of the market. There are 490 or a little more, 490 or more other companies in the S&P 500. But your money is rising and falling based on maybe 7 or 8 of these companies, right? That's why if tech has a sell-off on any given day during the trading week, we see the whole market dip. Now, is this bad? It's not necessarily horrible if you think tech is going to continue to be great over the next 30 years. Now, I'm not here to demonize the S&P 500, right? But I want to put this in perspective for you. I want to help you understand what you own when you're investing in the S&P 500. You don't want to blindly just believe that you're super duper diversified just because you have your money in a bucket of 500 stocks. Popularity does not equal safety. So just because it's popular to say invest in one big broad-based S&P 500 index fund or ETF, that doesn't mean there's no risk, because there's always going to be risk, right? So we have a couple of different possible futures moving forward. Let's just be real. Either tech is going to dominate and continue to dominate, right? The AI movement and cloud and semiconductors and digital platforms and all that. Maybe this continues to be the center of our economy for the next 30 years. We don't know. Or perhaps we could be entering the beginning of a major reset where if these giant companies somehow stumble, millions of people will be exposed or may be exposed without even realizing it because they have most of their money sitting in the S&P 500. Guys, let me know what you think in the comments below. Do you think that big tech is here to stay and moving forward for the next 20 or 30 years? Or do you think that tech is overblown? Let me know in the comments below what you think. Now, let's talk about solutions. Always want to talk about solutions when we're talking about this stuff. How should we be thinking moving forward? Number one is this. Guys, if you're getting anything out of this video, do me a favor and smash that like button below. Also, please share this video with your friends, your family, and your network of people. And don't forget to drop that comment below. I want to hear from you. And if you're not a subscriber to this channel, please consider subscribing to my channel. Now, let's get back to the video. How should we be thinking moving forward? Number one is this. Don't be hypnotized just by what's popular, okay? Number two, if you don't understand tech, don't let tech control most of your wealth. Stop putting large chunks of your money into stuff that you do not understand. And remember this, number three, the S&P 500 is not as diverse as you think it is. And if your portfolio right now, your overall investing portfolio is 50% S&P 500 and 50% technology stocks, you really have about 80% technology. Right? So don't just think, oh, the S&P 500, that's just separate. No, the S&P 500 is a large cap growth index fund or ETF that's heavily invested in technology, almost 40%. So when you own the S&P 500, you own technology. And that leads me to the fourth thing, which is diversification must be intentional. It's not as automatic as it was, right? Back in the days, 20 years ago, just put your money in the S&P 500, no big deal, it's diversified. Not necessarily anymore, right? Now let's talk a few practical ways that you can reduce your tech concentration or your tech exposure in your individual investment portfolio. First, perhaps maybe you need to add some small cap and some mid cap ETFs or index funds to your portfolio. Remember, the S&P 500 is a large cap. That means it's the 500 largest publicly traded companies in America. So if you go with some small cap and medium cap, this gives you some exposure outside of the big mega caps. Now, let me explain caps. Cap is just short for capitalization. Market cap, which you'll hear all the time as an investor, simply means the size or the total value of a company in the stock market. The S&P 500 is a large cap fund. Small cap is smaller companies. Mid cap is medium-sized companies, right? So consider adding those small and medium caps to your portfolio. Second thing is this. Consider adding some non-tech value ETFs or index funds, right? Value would be sectors like industrials, healthcare, financials, energy, right? These are the value sectors. Now, value sectors are different than growth, right? Value ETFs and index funds are buckets of stocks that are in sectors that are concentrated with companies that are a little bit more stable, more mature, and they often pay dividends, right? That's value. Whereas growth ETFs, growth index funds like the S&P 500 are buckets or sectors that are concentrated with companies that are growing fast or expected to grow fast, like tech or like communications. So these growth ETFs have more potential upside, but they also come with more risk. Now remember what I said, the S&P 500 is a large cap growth index fund concentrated in tech. So there's a little bit more risk to the S&P 500 today than it was 15 or 20 years ago. Now, the third thing you can do is sort of redirect this over concentration on tech that may be in your portfolio into something that may be outside of the stock market, perhaps real estate. Now, I'm a big real estate guy, love real estate, owned real estate for the last 25 years. Sometimes it takes more capital to get started in real estate, and sometimes it doesn't. There's creative ways to finance and so forth. But this is just another option for you in terms of diversifying your investment portfolio that is a proven winner over the long run. This could be physical real estate in terms of rentals. It could be commercial, residential, could be single families, or it could be multifamilies. It could be land. It could be warehouses, whatever. There's a lot of areas of real estate, but consider it because real estate is going to diversify you outside of the stock market. It's just a thought that you need to be aware of as possible. So yes, the S&P 500 can still be a powerful long-term tool to put your money in. But don't confuse a big number of companies in a bucket, S&P 500 ETF or index fund, with real diversification. There's more to it. Nowadays, true diversifications mean you have to be intentional, because the S&P 500 is not as diverse as you think or as it once was. Listen, if you want to learn more about managing your money intentionally and building the right portfolio that is specific to you, because personal finance is personal, go check out my 4 steps to maximize your money course at smartmoneybro.com. If you got value from this video, smash that like button for me and drop a comment and let me know your thoughts. And most of all, guys, share this video with someone who is an investor, just started to invest, maybe wants to get more deeper into investing. Share this video with that person. And if you want to know the 4 assets that I'm buying right now and I'm never selling, check out this video right here next.